Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. Today we're going to be taking a look at a Wall Street Journal article. Let me show it to you. The headline, a time-honored strategy puts your retirement at risk, and not just any kind of risk, by the way, of financial ruin. That doesn't sound good. I guess for effect, we get the tombstone with our 60-40 portfolio, which I guess means it's dead. And a zombie is apparently taking our retirement portfolio to, I guess, some deep, dark place underground. And specifically, the article is saying, look, the whole tried and true retirement portfolio of a 60-40 portfolio combined with the 4% rule could lead to catastrophic outcomes. That doesn't sound good. I really dislike articles like this. I think they're clickbait, and I don't normally see that kind of thing from the Wall Street Journal. But a lot of people emailed me about it. So we're going to walk through it because at a high level, it does raise a really important issue, and that is retirement planning is fraught with uncertainty. We don't know how long we're going to live, what inflation will do, taxes, the market, and so we all know there's a lot of uncertainty involved. So what we're going to do is take a look at this article, put it in some context, which I think it desperately needs, and then we're going to look at sort of at a high level the three ways we might think about addressing uncertainty, and then three things that might help us think about the best approach for us, including my personal approach to dealing with a retirement uncertainty. So we'll get to that in just a minute. So let's start with the article. I'll leave a link to everything below the video, although I will say for the Wall Street Journal article, you may need a subscription to access the article, but I'm going to walk through it briefly. With the 60-40 portfolio, the article just sort of went, it's had good years and bad, as the article points out. 2022 was a bad year. It shows the worst years here and the best years over here. Frankly, that's true of any portfolio or any asset. So this is not all that. I mean, it's maybe interesting from an historical perspective, but that's about it. But what the article then goes on to say is basically two things. The first is that many believe that over the next decade, real returns, that is after inflation in the U.S. for stocks, will be quite low. I think he put it at 1.65%. I think that's what he said. Maybe if I can find it quickly. Right here, yeah, 1.65% was one sort of estimate. That's the first thing. And the second thing, he points to an academic paper that says, hey, if we look outside the United States, yes, the U.S. has had a great run for the last 100 years, but if we look at 38 developed countries, so we're not, we're still talking about developed economies, and we sort of factor in all of their returns and inflation, we get a safe withdrawal rate, not of 4%, but of just 2.26%. And then if that weren't enough, he adds into the article how much debt our country has and the interest payments, and that Social Security could go belly up. So it's a real feel-good article. Now, in fairness, you could say, well, Rob, we need to think about these things, and absolutely we do, but we have to think about them in the right context. Let me try to give a little context to what this article is saying. First off, this idea of an after inflation return over the next decade of 1.65% is in and of itself, we've experienced that before. I mean, U.S. stocks were basically flat the first decade of this century. And certainly from a retirement perspective, if you retired in 2000, you saw your assets go down significantly over that decade. Of course, if you stayed the course, they've recovered nicely since 2009. Of course, we don't know what the future will hold, but the point is, we've had decades before that were really bad. And of course, the 70s were terrible in large part because of high inflation. And so, even with those bad time periods, at least so far, the 4% rule has held. We're going to talk a little bit more about that in a second. But as for the academic paper, here it is. I read it when it came out. I'll link to it below. I think it's an interesting paper from an academic perspective. But from a practical sort of retirement planning perspective, and even if we want to sort of dive into the 4% rule, I think this has very little applicability. And the reason is this. It constructs its data on returns, stocks, bonds, and inflation by looking at these developed countries over different periods of time. But then it takes all of this monthly data, kind of throws it into one big pot, and then runs simulations against that. So it might pick, for certain periods, data from Germany and then Latvia and then the United States and then a different country. And in that sense, it's just not practical. It's not constructing a portfolio that you or I could ever actually invest in. It would be, I think, useful if instead it just said, let's look at a global portfolio. You could think of a mutual fund like Vanguard's VT, that's the ticker VT. It's a global equity portfolio. I think it's about 60% US stocks, 40% international, and it's just based on market cap. And so those percentages are going to change as capital moves around the globe. It would be great to see a study on that and to see how the 4% rule would fare using that type of investment approach, because that's something we could actually replicate if we wanted to. Now, there may be issues getting data far enough back with that, but the point is this study, the way it constructs its data, may be perfectly fine from an academic perspective, just not very useful for you and I. And in fact, there's another study that Wade Pfau published about a decade earlier, and this is a chart from that study. He kind of, he didn't do the same simulation, but as you can see, he looked at individual countries and he calculated what he calls their safe max. That's just their safe withdrawal rate. That term was actually coined by Bill Bengen, who wrote the 4% rule paper in 1994. And this is interesting. What I find most notable about this, apart from the fact that Canada apparently, at least as of this paper, was winning, is that when you get to the really bad withdrawal rates, we could probably handle 3s, particularly 3.5 or higher. But when you get under 2, including 0.47, what do you notice about these countries? Italy, Belgium, France, Germany, Japan, and look at the years for their safe max. World War II, World War I, World War II, World War I, World War II. These are countries that were devastated by a world war. Now, of course, you may say, well, Rob, that could happen to the United States. Sure. World War III, I guess, could be fought in the U.S. and we could lose, and we could end up, after history is done with us, we could have a safe withdrawal rate, although I'm guessing that would be the least of our concerns at that point, but we could have a safe withdrawal rate of 1%. But as a practical matter, I know of no way to address that possibility, and certainly starting with a 2.26% withdrawal rate, like the academic study suggested, is not going to save us. And so, again, I think it's absolutely right that the future will not, very unlikely to look like the past. And maybe a period will come where the 4% rule doesn't pan out. But these academic studies don't really help us solve any real world retirement planning issues. So with that, then, let's get to sort of part 2 of this video. How do we deal with all of the uncertainties that we face in retirement? And I think, by and large, we take one of 3 approaches. The first is we get very conservative with our spending, right? We don't spend as much as we think we might be able to. We cut back in some way. And in fact, that really is the 4% rule. Let me show you what I'm talking about. This same paper by Wade Pfau, if we go up one slide, this shows us the safe withdrawal rate by year from 1900. He ends it based on data that he had, I think 78 or 79. And here's our 4% rule. This was from the mid to late 1960s. That was the worst time to retire from a safe withdrawal perspective. But you can see that there's a couple other in that same time period that were close. But most of the time, the safe withdrawal rate was much, much higher, right? And so, in fact, sometimes it was well above 10%. Even the average was probably, I would guess, somewhere in the 6 to 7% range. So a 4% initial withdrawal rate from a spending perspective is extremely conservative. But that's one way we could deal with all the uncertainties, is to be conservative in our spending. And I think as a practical matter, what that often means in retirement is when the market's down, maybe inflation's high, we saw that just a couple of years ago, retirees tend to tighten their belt. They spend less. That's what they do. So that's one way to deal with all of the uncertainties. Another way is with insurance, right? So we could buy an annuity. That would be one way to use insurance to deal with the uncertainties. I suppose we could look at delaying Social Security as a form of insurance, either delaying to full retirement age or perhaps all the way to 70. So that would be another way to think about insuring uncertainties. And maybe a third example would be if you relied on Medicaid to deal with assisted living towards the end of your life if you needed to. Of course, that would mean your assets were, for the most part, depleted, but Medicaid would be a form of insurance. We could think of it that way. So that's the second way, right? So there's conservative spending, there's some form of insurance, and then I think a lot of ways retirees think about dealing with uncertainty is to make their portfolio more conservative. You might have been 80-20 or 90-10 when you were working. You retire, you go down to 70-30 or maybe the vaunted 60-40 retirement portfolio. And that doesn't take away all uncertainty, but it certainly reduces the volatility of your portfolio because bonds have a lower volatility than stocks. And so that's a third way we might deal with uncertainty. And I think in many cases, what we do is some combination of those three things, right? We may delay Social Security. We may cut back on spending when the inflation rises or the market's down, right? And then maybe we make our portfolio a little less volatile with more bonds. So we could use a combination of those three things. But pretty much what we do to deal with uncertainty, I think for the most part, falls into one of those three buckets. And that still raises the question, okay, what's right for me? A lot of it's going to be driven by personality. There is no one right answer to deal with uncertainty. But let me give you three things to think about as we close out this video. The first thing is that we often worry about things that are at the extreme. And let me give you an example. I want to go back to this chart. You know, we worry about whether 4% is safe enough. But 4% is at the extreme. Every other time, going back to 1900, we can actually go back to 1871 if you want to, the safe withdrawal rate was higher. Now, yes, I know the future could be worse for us, however we invest, right? We can invest internationally. We don't have to put all our money in U.S. stocks. But however we decide to invest, the future could be worse. But we're talking already, we're starting at an extreme case that's only happened once in the last 100 years. And so as we think about how we're going to deal with the possibility that the 4% rule will not work going forward, we need to at least recognize that we're already starting at a very extreme case. And by the way, it's more than just the 4% rule, because remember, the 4% rule assumes a 30-year retirement. That in and of itself is an extreme case. Most of the people watching this video will not be retired for 30 years. The average retirement age in the U.S. is in your early 60s. Most people don't live into the early 90s. Yeah, I know you might. For all I know, you retired at 37, you'll live to be 114. If that's you, yeah, you're already living in an extreme case. But we need to recognize that the 4% rule is based on a 30-year retirement. By the way, that may be perfectly reasonable from a retirement planning perspective. But as we think about how to address these uncertainties, we should at least recognize that we're already talking about, in extreme cases, the 4% rule, a 30-year retirement. So we're talking about extreme cases right from the beginning. That's the first thing. The second thing is that however you choose to address uncertainty, it always comes at a price. There's no free way to address uncertainty, right? If you're going to buy an annuity, of course, annuities cost money, and depending on how long you live, that they may be a good buy or a bad buy, and they're not adjusted for inflation, so they expose you to the risk of inflation. You may choose to delay Social Security. That's something that I'm going to do, but that's not without risk. I mean, you know, we talk about the fact that the Social Security fund it could run out of money, and then we could just be paid a smaller percentage based on income from Social Security taxes in about a decade. So no matter what we do, there's risk. We could talk about a conservative spending approach like the 4% rule, which is a very conservative approach. But of course, that then costs us in the form of not spending money doing things we might have enjoyed doing, like maybe travel or whatever is important to you. So as we think about uncertainty, we almost always deal with it in the extreme cases. And whatever we choose to do to address it, it comes at a cost. By the way, the 60-40 portfolio comes at a cost as well. Its expected return is going to be lower than, say, an 80-20 portfolio. So there's always a cost. The third thing and final thing, and this has been my approach, and this won't apply to everyone, but I think the absolute best way to not only deal with uncertainty, this is probably the only, I'll call it, cost-free way to deal with uncertainty, and it's to do work that you love as long as you can in a lifestyle-friendly way. So for me, I don't want to be in a cubicle 9 to 5. Those days for me are past. I don't want to even be in a fancy office 9 to 5. Those days are past as well. But I'm working right now as I record this video. My family's upstairs. They're talking. They're visiting with some friends. And I'm down here for about a half hour. recording this video, and then I'm done. And I control my own schedule, make some income, which absolutely helps me address the uncertainties of retirement. Now, I get it. This sort of thing isn't for everyone. By the way, I'm not suggesting you all start YouTube channels. But if you can find work that you love that can be done in a lifestyle-friendly way, whatever that means to you, I think it can give you great purpose in retirement. It can reduce all of the risks of uncertainty that we've talked about by giving you extra income. It may be enough that you even actually defer spending any of your investments, or it may just reduce the amount of money you have to take out of your investments in retirement. Either way, it helps reduce the uncertainty of life, of retirement, while also giving you something that you enjoy doing with a purpose, and hopefully maybe something that can help other people. So there you go. That's my take on the Wall Street Journal article. Not a fan. How I think about uncertainty in retirement, different ways to address it, and just my thoughts on those. If you have any questions or comments, leave them in the comments below this video. And until next time, remember, the best thing money can buy is financial freedom.